last quarter was quite mixed for Indian equities. The valuations were quite reasonable to start with. On the back of good foreign fund flow into Indian equities and at reasonable valuations, the markets moved up considerably in the first half of the quarter. However, we ended up having some hiccups towards the end of the quarter, mainly on account of the announcements that came from the US on the US Fed policy. That is when the markets actually corrected quite sharply. What essentially has happened is US Fed has indicated that the quantitative easing program that has been on for quite a few months in the past is going to get tapered and come to an end sometime during the next year. What it effectively means is that global liquidity, which has been the key driver for emerging markets performance in the recent past, is going to get affected in the short term. And over the medium to long term, you will see dollar index and US bond yields rising. But however, markets have ignored the medium-term positives but have looked at the short-term negatives in the form of lack of global liquidity. That's the reason most of the emerging market currencies as well as markets have taken a beating. India has been no exception, but the fact that Indian macroeconomic challenges continue have also not helped the country. For example, if you look at the countries that have witnessed large amounts of volatility or downside in currencies, are all those countries which have had high levels of current account deficit or which have seen reasonable flows into debt portfolios from foreign investors, which is usually more hot money compared to equity portfolio. India unfortunately happens to be in both the lists. We have had high current account deficit as well as in the last 5-6 months we have had reasonable flows into our debt portfolios. So on this account, Indian rupee has been quite vulnerable and has depreciated quite considerably in the last few weeks. While this is a short-term negative and puts further pressure on our current account deficit as well as inflation from perspective of imported inflation, I think the medium-term positives would be in the form of low global commodity prices as well as low gold prices, because usually in a scenario where rising US yield or strengthened dollar index, usually gold or commodity prices soften, which should be positive from current account deficit of emerging markets perspective. And also that if you look at the medium-term implications of the whole issue, I think there will be corporates, at least half of our index basket, which will gain in the form of depreciating rupee, because many of these companies are either export-oriented businesses or have there is at least 50% of the index basket which gets its income from export-oriented business focus or from dollar margin profile. So clearly, these are the companies which will benefit, even though there is short-term volatility in terms of rupee-dollar movement. We expect that at least these companies will see earnings improvement over the next few quarters, albeit with a lag. Probably about 10% depreciation in rupee would lead to about 2% improvement in earnings. Currently, we are looking at low double-digit earnings growth for the market. So, in addition to that, probably we'll see 2 or 3% higher earnings growth for the index basket. At the same time, the valuations are quite reasonable. They are below long-term averages. They are below historical valuations of about 15 times. Currently, they are at about 13.5 times on a 1-year forward basis. And also, if you look at valuations from global investors' perspective, it's quite lower than 13.5 because rupee has depreciated about 15% in the last quarter. So clearly, for any US dollar investor who is investing into India, the valuations are already very reasonable at around 12 times. So from that perspective, we believe that while the short-term volatility is likely to continue, there may not be a large downside to Indian equities. From this perspective, we advise investors to start looking at building equity portfolio from a medium-term perspective whenever you see a significant volatility in the markets and which presents an opportunity for medium to long-term wealth creation. As far as sectoral perspective is concerned, I think clearly the sectors which are positively linked to INR depreciation would be the ones which will see benefits in the immediate short to medium term. We believe that the sectors such as IT services, pharmaceuticals, and some select auto ancillary companies will benefit because of their export-oriented nature. And also, one can't forget the rate-sensitive sectors because we believe that although Reserve Bank of India has paused in terms of its interest rate action, we believe that that trajectory is likely to continue with a lag towards the end of the year. If that were to come true, I think even the rate sensitives and the domestic cyclicals would do reasonably well in this market. So one needs to look at those sectors as well. And there is the third basket, which is quite immune to rupee dollar movement, for example, telecom or media. These are the sectors which are totally or majorly dependent on domestic factors and have little linkages with foreign currency. So to that extent, I think these are the 2-3 baskets where one can actually position themselves. And as far as our portfolio strategy is considered, we want to create a portfolio which has a very low vulnerability to depreciating rupee. So to that extent, we will be looking at companies and sectors which have very little negative impact from any further depreciation of Indian rupee. For our investors, from the products perspective, we recommend 2 products. One is Kotak 50, the other one is Kotak Select Focus. Kotak 50 is a large cap fund. It's a diversified basket of blue chip companies. We generally hold up to 40 companies in this portfolio. And we believe this in current volatile environment, this gives us enough opportunities to pick blue chip companies at attractive valuations. And also, for an investor, it offers superior risk-adjusted returns in these volatile times. So we suggest this large cap fund for our investors. The second product is Kotak Select Focus. This is a multi-cap or a flexi-cap product wherein there is a flexibility to move across market capitalization ranges as well as sectors. The investment premise here is at different points of economic cycle, different industries perform differently, and the idea is to look at sectors which are likely to outperform the broader market at any market condition. And this gives us enough flexibility to look at a few sectors which are likely to outperform the market and take selected concentrated bets in those sectors. And also the mid-cap composition can be up to 40% in this particular fund. So we believe that along with sector concentration and the ability to look for opportunities in the mid-cap segment, this fund offers a stable portfolio in the form of large cap component and also potential kicker from mid caps. So this would be ideal for investors who are looking for long-term wealth creation while having some flexibility through large cap composition, and the mid cap composition can give them potential kicker going forward. So overall, we believe that this is a time to start actively looking at equities and build positions for medium to long term. As the country is undergoing macroeconomic challenges, we believe that some of these are going to be on the mend going forward, and that presents a good opportunity since valuations are reasonable. And we suggest our investors to look at Kotak 50 and Kotak Select Focus as 2 options on the equity side to build a portfolio. Thank you. Not bad.